Welcome to The Explainer. Today, we're going to decode one of the most fundamental concepts in trading. We're going to learn how to read the hidden story that a stock chart is trying to tell us. Okay, let's dive right in. Have you ever looked at a stock chart and just felt lost? You see this chaotic jumble of jagged peaks and valleys, and you're not alone if you think it looks like random noise. But what if there's a hidden pattern in all that movement? Well, today, we're going to uncover the secret language traders use to find some order in that chaos. So this hidden language is really a core part of what's called technical analysis. And the big idea here is pretty simple. All the information about a stock, all the news, the hopes, the fears, it's already baked into its price. So by studying how prices have moved in the past, we can start to see patterns. And these patterns might just help us anticipate what could happen next, because a lot of the time, they're driven by the collective psychology of millions of traders all thinking the same thing. And right at the heart of reading those patterns, you'll find two of the most essential concepts in all of trading: support and resistance. Just think of them as invisible psychological lines in the sand. These price levels where big moves often start or stop dead in their tracks. Honestly, understanding these two ideas is the very first step to really reading a chart. So let's break them down. First up, let's talk about support. So imagine a stock's price is falling, maybe day after day. It kind of feels like it could just fall forever, right? But then something happens. The price hits a certain point and just stops falling. That's support. See, as the price gets lower and lower, the stock starts to look like a bargain to all the buyers who've been waiting on the sidelines. At that support level, enough of those buyers finally decide to jump in. Their demand for the stock finally matches the supply from sellers, and bam, the decline is stopped. And that's really the perfect way to think about it. This metaphor of a floor is just a powerful, simple way to visualize what support is. It's the level where buyers, as a group, basically say, nope, the price is not going any lower than this. So the crucial point is this: support isn't just a line on a chart, it's a whole price zone where the psychology of the market completely shifts. The buying pressure gets so strong that it absorbs all the selling pressure, and that's what keeps the price from falling any further. All right, so let's flip that idea on its head and see how this all connects. If support is the floor, well, it only makes sense that we'd have a ceiling too, and that's what we call resistance. Resistance is pretty much the mirror image of support. This time, a stock's price is rising. It's going up and up, but eventually it hits a point where it starts to be seen as, well, expensive. At this level, traders who bought the stock way down low are now eager to sell and lock in their profits. At the same time, any potential new buyers get a little hesitant to jump in at such a high price. Yep, so if support is the floor, resistance is the ceiling. It's that price zone where sellers come out in full force and all that upward momentum just fizzles out. It runs out of gas. And at this point, the whole dynamic flips. The amount of the stock for sale, that's the supply, suddenly becomes way greater than the number of people who want to buy it. That's the demand. And all that selling pressure causes the price rally to stall and, a lot of the time, to reverse course entirely. Seeing them side by side like this makes it all click, doesn't it? Support is the floor, and it's built by buyers. Resistance is the ceiling, and it's created by sellers. They're just two sides of the same coin, and it's all driven by that timeless battle between supply and demand. Okay, so we get the theory, right? Floors and ceilings. But how in the world do you actually find these things on a real live chart? Well, it's not magic. Traders use some specific tools to help them identify these key areas. Now, there are a bunch of ways to do it, but we're going to focus on a couple of the most common methods that analysts use every single day: drawing trend lines and using something called moving averages. And we'll also touch on why something as simple as a round number can create its own psychological barrier. The most basic tool in the box is the trend line. You're literally just connecting the dots. So in an uptrend, you draw a line connecting the lowest points of each little dip or pullback. That line then becomes a rising floor, a level of support. Now, for a trend line to be considered really valid, the price should touch it at least 3 times. Each one of those touches just makes it stronger. Next up, we have moving averages. Now, unlike a static trend line that you have to draw yourself, a moving average is a dynamic line that actually adapts to new prices. What it does is it smooths out all that chaotic price action into a single flowing line. And very often, that line will act like a moving floor or ceiling that the price will bounce off of. These tools just help traders visualize where that battle between buyers and sellers might get intense.
So here's why any of this really matters. I mean, identifying these levels isn't just some academic exercise. It actually forms the basis for creating real trading strategies and making informed decisions about when to buy or when to sell.
One of the most common strategies out there is to trade the bounce. The idea is that you're betting these floors and ceilings will actually hold. So a trader might decide to buy when a price drops to a really strong support level, making a bet that it's going to rebound. Or on the flip side, they might sell as the price gets close to resistance, expecting it to get knocked back down. But here's the thing. These levels don't always hold. And when a price smashes right through a resistance ceiling, that's called a breakout. And that can be a super powerful signal that a strong new uptrend is just getting started. What's really interesting is that once a level is broken, its role often reverses. So that old resistance ceiling can become the brand new support floor. And this brings us right back to what we've been hinting at this whole time. And it's maybe the most fascinating part of this whole concept. I mean, why does any of this even work? If you stop and think about it, there's nothing magical about a specific price. The real secret isn't in the numbers themselves. It's all about our psychology.
Support and resistance work in large part because they are a self-fulfilling prophecy. Think about it. Millions of traders all around the world are taught to look at these exact same levels on a chart. So what do? They place their buy orders at support and their sell orders at resistance. Their combined actions are what actually create the floor or the ceiling. It's also tied to this cognitive bias called anchoring, where our brains give special meaning to certain numbers, like a past high, or even just a big round number like $100, just because it's a memorable reference point.
And that leaves us with a pretty provocative question to think about. Are these levels some fundamental law of the market, or are they just a construction of our shared beliefs? Something to ponder. And that's our explainer on support and resistance, giving you the foundational building blocks to start reading the hidden language of the charts.